Put your hands up if you have a mortgage, and now keep them up if you want to figure out how to pay them down faster. If you are Canadian, you probably have a mortgage with a Canadian bank or Canadian lender attached to the property. What that means is this. You own a house and you couldn't afford to pay for it all when you bought the house, so you partner with somebody else using the house as collateral to give you money coupled with your money to acquire the home. Right? That's how this whole thing works. And in exchange, in that agreement, when they're going to give you a mortgage, the lender, and we'll just use bank from this point forward because for the most part it is a bank, the bank is agreeing to lend you under terms that they dictate. So the reason why our mortgage costs are generally pretty high is because loans are amortized, meaning part of every payment has to go towards reducing what is actually owed so that eventually it gets paid off. So when you hear the term 25-year amortization, that means if this plan followed through for 25 years, it would be paid off. And you don't have many options here to get 25-year actual agreements. We more operate in the 3, 4, 5-year range. I've never seen 25 actually. I don't think it's possible. But in any case, they base it on the plan as if you were going to pay it off in 25 years. So they take all of that, all that information, and they figure out if you're going to have this big loan at the beginning, we're going to have to start paying small numbers towards paying down the principal so that we can eventually reduce your outstanding balance. Then you own the house free and clear and you remove the mortgage. But if you look at your statements early on in your mortgage agreement, you'll see that very small numbers are actually applied to principal. If you look at it, though you may have a 5% or 6% or even 3 or 7% mortgage rate, what you're actually paying in terms of interest dollars is a lot higher. Like it's significantly higher. Okay, so you're a part of each payment that you're making, the majority of it's going towards covering interest. That's not 5%, that's more like 70%. It's not an interest rate, it's the portion of your dollars going towards paying down the loan. That being said, this whole amortization schedule and how this stuff works and how you pay off your mortgage, we have been trained very cleverly to just consider that as the only option to hold a mortgage. That's it. Amortized loan this way, these terms, and for the majority of it, it's one of the big 6 banks that gets that business. Now, don't get me started on how they're making money off of this, although I will let you know your deposits that we're putting in there and they're paying us 0.01%, they're lending it back to us at 5% for mortgages, securing property. Anyways, the banking business is fantastic. It works really well, and that's why they're on every corner in our country. But I digress. Let's get back to the point. This structure where you're paying a portion of every payment, the principal portion is interest, and collectively that number is what you pay every single month. There is no fast tracking to that for the majority of Canadians. There is a better way of doing it. And it would take a lot more discipline if we didn't have proper tools at our disposal to put it to use. What if you did this? Like completely rethink about how you do banking. Instead of having that checking account where you get paychecks into and then you use that to pay your credit card and then you pay all your expenses out of that. Then you got savings accounts over here. You have all this stuff scattered. And then you have a mortgage that you transfer money to. What if you did this? What if you had everything was this blanket mortgage account and it owed a lot of money? Of course, that hasn't changed. But as you got paid, when you received your income, it goes into this account to effectively reduce how much money you've borrowed. Even if it's just temporarily, you've reduced. If you have an extra $5,000 comes in and you owed $500,000, now you owe $495,000. And the interest is going to be charged on the smaller number while it's paid down. Now you're going to use that money, you're going to spend it back up, so you'll get back to $500,000, sure. But in the meanwhile, you had an opportunity to pay down your principal, which is going to reduce how much interest you're going to be paying. And what if you did that with everything? What if your emergency fund was not over there earning 0.01%, which is nothing. Instead, you had that over here and reduced your outstanding balance for a little while. Or forever, if you don't need the emergency funds. This strategy, some call it velocity banking, it works. It absolutely works. You will shave thousands and thousands of dollars of interest that you would not have to pay if you just did this instead of what we're normally doing. Actually putting into action is very cumbersome. Now, if you're going to try and do this and you're with TD, RBC, Scotia, whatever, it's going to take a lot of planning, a lot of note keeping, a lot of money transfers, a lot of delays. It's just tedious. And so that's why nobody does that. But there is a bank, there is a product that is offered that can do this for you. It's called a Manulife One. Okay, Manulife, big Manulife. They have a mortgage business and they called this product Manulife One because it's one account that handles all of this stuff. And when you go in there, you can section off, this is my savings for my travel, this is my bill payment, whatever you want. You could have these goals within this one account. It's a pretty rad tool. Now, I knew about this when I got my probably third mortgage, and I should have done something about it. Not a day goes by where I'm not upset with myself for not taking advantage of that. But I passed on that. I ended up choosing a different product that was marketed as the same thing. Turns out it was really not at all the same thing. It was just another mortgage with a HELOC component to it. It just didn't operate the same way. Now that I know enough to share this with you, I do think you should be curious about this product. If you do want to ask questions about it or learn more about it or just bounce ideas off me with it, I don't sell anything, but I can help you meet somebody or teams that actually can get you that product into your life. If you qualify, not everyone does. I don't, for example, because of my status and where my numbers are at. But a lot of people will qualify for this. And if you do, I think you owe it to yourself to really give it a shot and see if this could work for you. You could shave thousands of dollars off your mortgage costs over the years and reduce your payment schedule by many years. So go on, get wealthed up.